Welcome back, everybody. It's good to have you to another real estate market update for the Greater Milwaukee Area, this time February 2023. So the weather is not the only unusual thing that's going on, at least that is pleasant. I took this picture last Sunday down on the lakefront, 51 degrees and sunny. A lot of you are watching this from out of state and asking me sometimes how's the winter going, and well, we actually haven't had much of a winter this year so far. The less pleasant thing is that the real estate market is collapsing in Milwaukee. I really don't have another word for minus 65% in volume. That's what we have seen in the month of January compared to last year in January. So that's a really dramatic reduction in volume, and what that means for real estate values and for real estate prices in the Milwaukee area is an interesting topic for today. The other thing, maybe in the same context, is that a recent study showed that 2/3 of Americans are concerned about an imminent crash of the real estate market. So of course, we have to take a look at that and see what's up with that. But before we go there, let's take a quick look at the latest numbers from the Milwaukee MLS. I have here the results from January. And you can see here inventory is up just a little bit. If you've seen the last market update, not a surprise, about 2,300 units, plus 10%, of course, magic of small numbers, 10% more of almost nothing doesn't mean much. And a lot of that inventory that's sitting out there is not very attractive. So it's a little bit the bottom of the barrel. We should have this time of the year 10 or 11,000 listings. So very tight inventory, but interestingly enough, accepted offers were down 65.6%. So a very, very small number of houses have actually sold in January. This is a new metric I haven't shown you in the past because I like talking about sold, but we have to wait another month to see how many of them are actually closing. But in any case, this is a very, very small number, and it shows how the marketplace is compressing because of the lack of inventory, because of high mortgage rates, because of inflation and concerns about recession. So that is the result. Interestingly to note here that a lot of these offers that actually went under contract have been very, very competitive. So we have seen some of our listings go with more than 10 offers and sell on the first weekend. And also talking to other real estate agents, they're experiencing the same thing. So the deals that are selling, that are attractive, they're selling very, very competitively, which makes it tough for buyers because you don't have much to choose from. So in January, we closed 1,072 deals. That is still offers that got accepted in December of last year that closed this month. That's down 32%, pretty much as expected. Days on market, also no surprise, 21 days. Kind of, it's higher than what we had last year in fall and summer, but still a very fast-paced market. Compare this to the 85 days on market that we have seen in January of 2015, which, as always, is our benchmark year. That was the last year where we had a normal balanced market in Milwaukee. So what is this doing to prices? And this might be a surprise to you, because despite the compression in volume that we're seeing, prices are actually up almost 11%. So median home price in the Milwaukee area now almost $66,000. So supply is down, demand remains high, prices are up. We're seeing a lot of bidding wars actually happening, which is just a very strange combination to see such collapse in volume, and at the same time, the few properties that are selling very, very competitively. All right, here's a closer look at the data. On the left side, you can see number of listings, and I put here in green a little bit what we were hoping for or anticipating for January. We were hoping for some inventory, but that did not happen. New listings are very, very weak. But on the right hand, you can see what's happening to the prices of the new listings in January. They are up 10%. Before we discuss more what's going on in the housing market, let's take a quick look at some macroeconomics, because that's the environment that is dictating everything. So inflation keeps trending down. Good news from that end. We had the new consumer price index come out yesterday with 6.4%. That was the 7th month, I believe, in a row where we're trending down. So that's a good thing. We're still quite a bit away from our goal to less than 2% inflation, but at least we're moving in the right direction. We still have quite a ways to go, and you can see this here very clearly. This is a chart that shows the M2 money supply that is still inflated. You might remember that the Fed has dumped a lot of money into the economy to keep it going during the lockdown. And of course, when you put more dollars into the economy, the value per dollar goes down. So you need to bring more dollars to buy the same goods and services. And of course, it takes a while to suck that extra liquidity out of the market. It's moving in the right direction, so what they're doing is working. But you can see from this chart, it is going to be a little while yet before we hit the trend line here, probably somewhere down here. But I'll leave this to some smarter people than me to determine when we're gonna get there. It will be a while though. Job market is really good looking. We had some news lately from tech companies laying off a lot of people in the 10,000s. But this here is in the millions, and you can see it hasn't really made a dent in those charts. The blue line shows the layoffs, the red is the unemployed, and the green is the open jobs. And that's the real kicker for me, that we have more open jobs than unemployed people. So that is really, really robust. Unemployment rate in the US, 3.4% currently. And unemployment rate in Wisconsin, always a little bit better than the US average. I can say proudly 3.2%, so we're doing good there. Next, let's take a look at what's happening with mortgage rates. So we have slightly good news there. We are down from the peak. Last year, November, we have seen 7.5%. If you had less than perfect credit, maybe even 8%. So of course, a lot of people were sticker shocked. A lot of buyers have left the market and stepped on the sidelines. And we're waiting for better mortgage rates, and many of them are still waiting, but we're moving in the right direction. 6.1% currently, and that is trending down. And if you're confused how it is possible that the Fed keeps raising rates, in the meantime mortgage rates are coming down, watch my January market update because the explanation is in there. And also the reason why a lot of experts are predicting that rates are going to come down even further than where they are right now. We should be seeing lower rates as we're going into summer. All of that in my January video, so I don't want to repeat that. Go take a look. Maybe I can put a link somewhere up here. So mortgage rates are, of course, very important, both psychologically, but also just really financially for the affordability. How much of a house can you afford? How much of a payment can you afford? And we know there's a very strong connection between buyer demand and mortgages. And of course, if you're up here somewhere over 7%, that is really killing the market. If you're between 7 and 6.5, so high sixes, that is limited buyer demand. Below 6.5, that is good buyer demand. And if we're going below 6%, so in the high fives, that is going to be strong buyer demand. And here's one thing. A lot of people are currently waiting for interest rates to come down, because then they think then will be the right time to buy a house. I would suggest buy the house before rates are coming down, because when rates are coming down, everybody and their brother will be buying and you have to compete with them. So buy the house now and refinance later if and when rates are coming down. Currently, it's looking like it's going that direction, even though they ticked up a little bit last week. We're moving in the right direction, and long term for the rest of the year, we're expecting rates to come down, maybe even below 5.5 towards the end of the year. That's at least what the Mortgage Banker Association is predicting. So mortgage rates are, of course, a very, very important factor for a marketplace, because high mortgage rates have the ability to cool down a market, because they are going to bring down buyer demand. As mortgage rates are going up, a lot of buyers are leaving the marketplace and they're saying basically, screw that, I'm waiting for lower rates before I'm going to buy a house. So demand is coming down. As you know, prices are always made up in a market between supply and demand. So let's go take a look on the supply side. So this chart shows you new listings over the last 6 years. It's the typical seasonal pattern that you would expect here. Inventory starts out here in January, then more and more new listings come on the market as we're going to spring and summer. Usually we see the peak in new listings in May and June. And then in summer we're plateauing, and then maybe another peak here in September, back to school market. And then we're dropping off towards holiday season. So this is the typical season that we see in most years. In orange, you can see the COVID year that really screwed us. But the red line here is the important one, and that is 2022 last year. And it started out pretty normal, even though low on the supply side. We were all wishing there would be more inventory, more new houses coming on the market. So we were low the whole spring season. That it is what was causing that crazy market that we had. And then We hit summer, and that is when mortgage rates started going up noticeably. And people were saying, all right, mortgage rates are going up. That is going to bring buyer demand down. That means we are going to see more and more inventory sitting on the market, aging on the market, which will eventually force sellers to sell their houses for less, accept a price reduction or lower their list price. That was the theory at the time. So we were expecting inventory to follow kind of this trajectory, and as inventory would pile up, prices would be coming down. Now, what actually really happened is that inventory came crashing down as well, and new listings came crashing down as well. And that has to do with something that we call the rate lock effect. So as rates were going up, a lot of sellers are also buyers because they need to live somewhere. And they were looking at the rising interest rates, and they said, no, I'm not going to put my house on the market because if the rates are so high and I'm buying a more expensive house, I'm looking at a lot higher monthly cost. So I'm postponing my plans, not putting the listing on the market. So inventory became actually even more scarce than it was before. Minus 21% year over year here in December is where we ended. And that basically led us to the situation that we have today. Now, when you look at this on a national scale, you can see that inventory is down minus 9.3%. That's month over month, January 2023. And what stands out here are just a few states. Wisconsin is one of them. So we are hit harder by that inventory shortage. We have less inventory this year, or a higher reduction than most other markets in the US. So if you're thinking all of this is confusing, maybe even somewhat contradicting, you are certainly not alone. A recent study from NerdWallet showed that 67% of Americans say a housing market crash is imminent in the next 3 years. And that has to do with the information that they're hearing every day on the news. And even if the information is factually correct, it can still be very confusing. Let me give you an example. These were some headlines that we have seen recently in the news. US foreclosure filings surge 115%. When you hear foreclosures are up over 100%, your brain immediately goes back to 2008 and what we have in recent memory and say, oh my God, the market is going to go crash, foreclosures again. Now, when you look a little bit more in detail, here is what they're actually saying. Take a look at the blue arrow that I've put here on the lower right corner. The data is provided by Adam, and that shows an increase of 115% from 2021 to 2022. So when you look at this, we are still way below the average that we have seen over the last 6 years, which is just shy of 600,000. Now this gets even more interesting when you look at the big picture and you zoom out and you go back to 2008, 2009, 2010, when you see we had almost 3 million foreclosures back then. And when you look here, yes, we're up 115%, but again, this is magic of small numbers. When you put this in context, you understand it is not a huge wave of foreclosures. It is a tiny wave of foreclosures that we're seeing. 324,000 has certainly not the ability to move the needle in the US housing market, but it all depends on the context and it all depends on the perspective that you have. Now, another factor to take a look here is the lending standards. This is a chart that a data point that I look at every month, but I rarely show it here. But in this context, I want you to take a look at this. So this is by the Mortgage Banker Association, and they're basically measuring the credit availability to home buyers. And it was back in the heydays, 2004, 2005, 2006, think subprime loans. You could get a loan even if you didn't have a job or income. They would still give you a loan for a house. We had here a very, very high index, almost 900. And of course, it crashed way down. We got a little bit smarter. The banks got tighter in their lending standards. And then over the last years, you can see 18, 19, we started to loosen up a little bit carefully. And then the pandemic hit, and now we're talking about recession, and lending standards are as tight as they were ever before. So the odds of being a large number of bad loans out there that people all of a sudden go foreclosure, and then we see a wave of foreclosures coming in, is basically zero because the lending standards are so tight. If you have recently tried to get pre-approved for a loan, you know what I'm talking about. So the big question remains, what are the odds that we're going to see a real estate crash? And if not a crash, maybe a real estate price correction. And if you remember last month, I showed you a chart that was a summary of all the different expert opinions, big banks, the big researchers, what they were predicting for 2023. And some were a little bit optimistic, some were pessimistic, some were plus 5 or 6%, some of them were minus 5 or 6%. And I'm not ready to show you an updated chart. Maybe I can do that next month. But what I want to show you is this. This is from Goldman Sachs, and they put out their forecast on January 10th for this year with minus 6.1%. And then based on what they were seeing in the economy in January, they revised their forecast on January 24th to a minus 2.6%. So they're still predicting a slight minus, but keep in mind, this depends a lot on which markets you are emphasizing. And with a lot of markets in the US, especially on the coasts and in the south, where real estate prices went just nuts over the last years. We've seen increases of 30 and 40% of prices. That is, of course, not healthy. And these markets need a little bit of a correction. But we're in a different situation here in the Midwest. I'll bring this chart again because I think it's so important to really keep this in mind. So in light blue, you have here the median sales price in the Milwaukee metro area. So that includes the surrounding counties as well. You can see our seasonality with the winter lows and the summer highs. And you can see that we've been following a pretty stable trend over the last years. In red, we have the national average, which is, first of all, considerably higher than we are. And secondly, it really started taking off from this trend line. And there's a lot of markets on the coasts that are way up here. And if I look at Milwaukee and I compare it with other markets, there should not really be a reason. Milwaukee is, in my opinion, a very attractive city, and there should not be a reason why Milwaukee properties are being sold so much below national average. We should be at least at national average or a little bit over, if you ask my opinion. And so I think over the next 10 years, Milwaukee prices are going to develop more towards where the national average is, because we're in a very attractive city. And if you haven't noticed yet, I'm a big fan of what's going on in Milwaukee. We're moving in the right direction, and I think we're becoming more and more attractive every year. And money always goes where it finds the biggest value. And we offer a lot of value in Milwaukee and Wisconsin compared to a lot of other markets in the country. And here's another take that I have to share with you. So this is a little bit about the financial health of the US. And you have here I have 3 slides here, and this is the median net worth by county. And you can see here, the darker the color, the more net worth, the more money there is. It looks like Wisconsin and Minnesota are actually in a pretty healthy place. You know, the dark blue are the usual suspects: Southern California, Seattle, Denver, Boston, New York, etc. A little bit down here in Florida. But when you look here, we're actually not doing so bad with median net worth by county. A different take is here median credit score. So this reads a little differently. The darker it is, the higher the median credit score. And it seems like Minnesota and Wisconsin are financially a little bit more conservative than some of the other parts of the country. So if you look here on the scale, if you get into dark blue, that goes into a high 700 median credit score. And it may not come as a total surprise to you when you look at the next slide, and that is residents with delinquent debt. So with all the problems that we still have in Milwaukee and the Milwaukee area, we're generally doing really good. Just look at this and compare this to some of the other markets in the US. So all that adds up to my big picture of when I'm looking at Wisconsin, when I'm looking at Milwaukee, and thinking about what's going to happen here potentially in the future. But the future is always hard to predict. I can tell you with much higher certainty what's going to happen in the next few weeks. The year 2023 has already started with a lot of bidding wars. So any listing that is attractive has ended up with 3, 5, 10 offers. We had one last weekend that had 13 offers. So if a listing is well priced, well marketed, and it looks like a good deal, condition and price, then it's going to get a lot of attention because inventory is so tight. And no surprise, Milwaukee is one of the top 3 most competitive markets in the US. When you think of the last 3 slides that I've shown you, I think this is what explains at least part of it. Mortgage rates are trending lower. We've discussed this. So this is a double-edged sword, because if you're standing on the sideline right now as a buyer and you're thinking about waiting until mortgage rates are coming down, you can do that, but know that you're also going to face a lot more buyer competition because a lot of other people are thinking the same way. So even Dave Ramsey has started saying, never mind the mortgage rate, buy a house now and refinance. That's how he says it, refinance when the rates are coming lower. Of course, there's a caveat to this. Make sure you're financially conservative and you really can afford it at the current rates. It's a very good bet that rates are coming down, but nothing is guaranteed in this world. Spring inventory will rise slower than it did in the last few years. So we're going to see more inventory. We're working on a few listings that are just not ready for the market yet, but they're coming. And I know there are other agents also are in the same situation. So there's going to be more inventory, but it's not going to be a whole lot. It's going to remain a very tough market, a very technical market, very, very skill-based, and it's going to be tough for part-time agents because they just don't have that market exposure that they exactly know what's going on. And I anticipate that a lot of them will continue to leave the industry. So not an easy market to be an agent. Buyers, it's also not easy to be a buyer because you will have to be patient and you will have to be prepared in order to score in this market. Still possible. We're still doing it all the time, but it's not easy. It's going to remain a seller's market with very strong demand that is pushing up prices. A word of caution here, there are some listings on the MLS that are just overpriced, and people are thinking they can take advantage of the situation and this market, and the market is very ruthless with that. You see those listings, they're not getting offers, they're not getting attention. They will have to correct their prices to something more reasonable because buyers are still very much aware of the value of their money. So if a listing goes out there totally overpriced, it is going to sit, and we also see that every day. So what's next? If you have real estate plans for 2023 and you are still a little bit uncertain on how to best play this market, how to lay out a timeline that works for your personal situation and for your personal goals, and you want to pick my brain a little bit, feel free to reach out to me. I would love to hear from you. You can give me a call or send me a quick email. You have my contact information here on the screen. You can also schedule a call with me. Just go on my website, onpointrg.com, and just click on schedule a call. You have access to my personal calendar there. I still have a few appointments open for this week. Just pick one that works for you, and then we can hop either on a Zoom call or on a phone call and talk about your personal situation, if you should make a move this year in spring, or if it's better for you to hold off and wait, depending on your personal situation. The other thing you can do, whether if you're on the buying or on the selling side and you just want to keep an eye on the market, we can hook you up with access to the MLS for a specific area that you're interested in. I will put a video here that you can watch next. What is MLS, how you can get access to it, and what's the benefit of being on the MLS. That's also something you can do on our website. Just request MLS access and I'll be happy to sign you up for that. That's all I got for you today. Thank you very much for watching. I'll see you at the next one.